Hi there. So welcome to the final module, Internal Controls and Audit. At the end of this module, you should be able to explain the various concepts when implementing corporate governance, explain the role of the internal audit department in ensuring companies are adhering to good corporate governance principles, and explain the various internal audit assignments and then value for money in that order. You should be able to explain the roles as well of the board chairman, the role of the CEO of the organization in that order. So let's look at this in relation to that. So in discussing issues about internal controls and audit, the first thing we want to talk about is corporate governance in action. So when we talk about corporate governance in action, three things come to mind: segregation of the role, committees, and then internal audits. So when we say corporate governance in action, we are talking about how organizations can actually practice what we refer to as good corporate governance. So in order to talk about how organization can practice good corporate governance, three things we have to talk about: segregation of roles. So segregation of roles. 2, committees. And then 3, internal audits. Segregation of roles, committees, and then internal audit. Now, what do we mean by this? Now, when we say segregation of roles, the first one, we are talking about how we separate the role of the CEO and then the role of the board chairman. Okay? That's segregation of roles. 2, when we talk about the committees, we are talking about the various subcommittees like the audit committee, nomination committee, risk management committee, remuneration committee, among other committees in the organization. Then when we talk about the internal audit, we will get into that in that order. So let's begin the first thing about segregation of roles. Now, best practice and strongly recommended under corporate governance codes in many jurisdictions. The first thing is that the role of the board chairman and then the chief executive officer should be held by different individuals. So to enhance good corporate governance, there has to be a segregation of the role of the CEO, who has to be an executive director, and then the board chairman, who has to be a non-executive director. So what are some of the roles of the board chairman? What is the duty of the board chairman? 1, the board chairman is a non-executive director, and they ensure that there is a full information and full discussion at board meetings. So he is the one who chairs the board, he directs the information, and he makes sure that all discussions are done very well. 2, he ensures satisfactory channel of communication with external auditors. So the board chairmen must ensure that there is a satisfactory communication between the organization, between the management, and then external auditors. 3, runs the board of directors. So the board chairman is responsible to administer the board of directors, direct the board of directors in that order. And then the last one is that he ensures effective operations of subcommittees of the board. So you know that the board as a whole is going to be subdivided into some committees like the audit committee, like the remuneration committee, like the risk management committee, like the nomination committee. So the board chairman must ensure that all these subcommittees are operating effectively and efficiently for the organization, or to enable the organization to achieve its objective. Then the next thing there is the role of the CEO. Now the CEO is an executive director. His roles include to ensure the effective operational functioning of the company. That's the first role that he plays. Second, it is important that there is a distinction between the chief executive officer and then the chairman, as the chief executive heads the executive directors, and then the chairman heads the non-executive directors. So the chief executive officer is the head of the executive officers or executive directors of the organization. In other words, the chief executive officer, aside taking the day-to-day decisions, aside administering the running or the functioning of the organization, he is the one that leads the organization in the day-to-day running. So he directs the employees as to what to do. He directs the various departments in the organization in relation to what they must do in that order. And also, he is responsible to make decisions in the best interest of what? The shareholders in that order. So that is what you have to understand when it comes to segregation of roles. When it comes to practicing good corporate governance or best practices, there is a recommendation that organizations should ensure that the role of CEO and the role of board chairman is held by two different people so that the organization can operate well, efficiently, and effectively. So the second segment is to talk about various subcommittees of the board. And then the first one we want to talk about is the Audit Committee. Now, an Audit Committee is a committee consisting of non-executive directors which is able to view a company's affairs in a detached and independent way and liaise effectively between the main board of directors and the external auditors. So the Audit Committee is there, and they are non-executive directors, so that they can independently look at the operations of the organization. Then they are also there so that they can channel communication, they can channel information as to how internal control system in the organizations are working with what? The external auditors, to ensure that work is done well and to ensure that the objectives of the company is being achieved in that order. Now, best practice for listed companies also guides that the company should have an audit committee of at least 3 non-executive directors. In case of smaller companies, 2 non-executive directors. So for best practice, if it is a large company and it is listed, it must have at least 3 non-executive directors who are in or part of the audit committee. 2, at least one of the audit committee members should have a recent and relevant financial experience. So a member on the board, on the committee, or on the audit committee, at least one of them must have a relevant and recent financial experience in relation to how the finances are run, what we mean by assets, what we mean by acquisition, in that order. Okay, but a big question we ask ourselves is, what is the objective of the audit committee? What is the objective of the audit committee? Increasing public confidence in the credibility and objectivity of published financial information. So they are there to ensure that the public can now confidently trust the financial statements that has been authorized by the board or the management of the organization and has been published. Because the audit committee is there, we will look at their role later on. They play a monitoring role to ensure that the internal control system within the organization are operating well in the organization. So they put that confidence back to the public to ensure that all financial statements published actually represent a true and fair nature of the organization. 2, assessing directors, that is particularly executive directors, in meeting their objective in respect to financial reporting, and then strengthening the independent position of the organization in relation to external stakeholders by providing an additional channel of communication. So that is the objective of the audit committee. Now let's look at the functions or the roles of the audit committee, and I have a lot of them in the handouts that you see there. Monitoring the integrity of financial statements. So they have to make sure that the financial statements prepared is not biased. The financial statement prepared is honest. The financial statement prepared actually represent the true state of affairs of the company. So they have to monitor the integrity of financial statement. 2, reviewing the company's internal financial control. So what are the financial control system in the organization? The audit committee must review the financial controls regularly to ensure that the financial control systems are operating efficiently and effectively within the organization. And 3, monitoring and reviewing effectiveness of the internal audit function. So the internal audit department, the audit committee must review and monitor to see whether they are undertaking their roles, whether they are undertaking their responsibility independently, and to see whether their work is actually adding some value to the company. And then reviewing and monitoring external auditors' independence and objectivity and effectiveness of the audit process. So when external auditors come and they are auditing the financial statement, the audit committee ensures that the external auditors are carrying out the audit in an effective and an efficient manner so that they can issue an independent audit report that represents the true affairs of the company. And then another thing is about developing and implementing policies on the engagement of external stakeholders, external auditors to supply non-audit services in that order. So these are some of the things that we can talk about in relation to the roles of the Audit Committee. But in addition to the meeting of objectives as stated above, there are some disadvantages that the Audit Committee faces. One is that it may improve. There are some advantages about having an audit committee, okay? When we have an audit committee, there are some advantages that we enjoy. Aside the role they play and how important you have seen the roles are, they may improve the quality of the management accounting of the organization because internal functions will be operating effectively and efficiently. And then two, it should lead to better communication between directors, external stakeholders, and other management. But the audit committee may lead to some disadvantages of the organization. When there is audit committee in the organization, there are some disadvantages about it. One, fear that their purpose is to catch management out, okay, or is to fish out management error. So there is a fear that when there is audit committee, because they have to monitor, they have to review the operations of management, there is that fear that the organization will not be able to, or the audit committee has been employed to undertake that. Two, non-executive directors may be overburdened with details. So sometimes these non-executive directors will be provided with information that is way beyond their understanding of the organization. Then a two-type board of directors may be provided there in that order. And then in addition, there is additional cost in relation to running an audit committee because their roles is going to be different from the board of the organization, and so there is an additional cost that the organization incurs in that order. Now let's look at the relationship between the audit committee and then the internal audit function, because we said that one of the roles of the audit committee is to ensure that to review and monitor the work of the internal audit department within the organization. So best practice suggests that the audit committee should, one, ensure that internal auditors the internal auditor has direct access to the board chairman and to the audit committee and is accountable to the audit committee. So best practices suggest that the internal auditor, the internal audit department must report to the audit committee, and they must have a good communication relationship with the board chairman and the management of the organization. Two, review and assess annual internal audit work plan. So the audit committee must review the annual internal audit plan. They must receive periodic reports on the results of the internal audit work. They must review and monitor management responsiveness to the internal audit findings and recommendations, because when internal auditors are carrying out their work, when they issue their reports, they are going to make suggestions that, oh, A, B, and C, this system is not working well. Maybe if we put this in place, it can help the organization. So the audit committee must ensure that the board or the management is implementing the recommendations that has been laid out by the audit, the internal audit department. Then meet with the head of the internal audit at least once a year without the presence of what? Management. So there has to be something like private meeting between the audit committee and then the head of the internal audit department in the absence of the board, in the absence of management, so that willingly they can trash out and bring out confidential information as to how their work is being carried out within the organization. So aside the audit committee, there are other subcommittees in the organization called nomination committee, remuneration committee, risk management committee. So let's look at them quickly. The nomination committee, as the name suggests, the function of the nomination committee is to suggest suitable candidate for appointment to the board and other senior posts. So board position, who should be the board chairman, who should be part of the board, that is a board of directors. There is another committee called the nomination committee, and they are the people who will suggest suitable candidates to fit those positions in the organization. Then aside that, we have what we call the remuneration committee. As their name suggests, it is a committee that determines fair rates, pay structure, compensation, pension rights, share options, for management and other senior employees of the organization. In other words, the remuneration committee is there to determine the salary and then the payment, wage and salary payment structure of the board and then of the senior management of the organization. Then the next committee is the Risk Management Committee. Now we've discussed issues about risks of the organization, but every organization is to some extent is faced with some business risks. That is the risks that the products may become technologically obsolete, the risks that they may be losing key staff, the risks of catastrophic failure in their IT system, the risks of change in government policies, then the risks of what? Fire or natural disaster. All of these risks are exposed, or businesses are exposed to any of these risks. As such, companies need to, 1, identify potential risks, and 2, decide an appropriate way to minimize or mitigate those risks. So the Risk Management Committee is there to identify the risks, to identify the impact of the risks, to assess the effects of the risks of the organization, to bring out relative ways through which the organization can mitigate the risks of in that order, so that the risks will not impact upon the organization. Now, there are various ways that risks can be managed. Risks can be managed by insurance, insuring against the risks. Risks can be managed by hedging, that is, if it is a financial, foreign exchange risk or interest rate risks, we can use hedging in that order. Risks can also be managed by management designing a carefully crafted plan so that it will go well in that order. So, what are the ways that companies can reduce risks? 1, they must identify the risks that the business is faced with, right? We have already stated that. Then they must look at the type of the risk. Is the risk operational? Is the risk financial? Is the risk about legal compliance? Then the company should then assess relative importance of each of the risks and scoring it on a combination of its likelihood and then the potential impact in that order. This is what will determine whether the company should use insurance, whether the company should implement better procedures, whether the company should hedge against it, or whether the company should improve upon the salary or train its staffs in that order. Sometimes the company may be forced to accept the risks as an inevitable part of its operation. Now, there are some risks that are inherent to businesses and they can't do anything about it. As such, in such circumstances, the business will be forced to accept those kind of risks and take it in that order. The next thing we want to discuss is about internal controls and risk management. So you will realize that the Risk Management Committee in the organization are going to really be engaged in sort of like the day-to-day running of the organization, how internal control systems are working in the organization. So one way of minimizing risks is to incorporate internal controls into an organization system and procedures. Examples of this can include that one person checking another person's work, looking for important documents in safe places, or locking important documents in safe places, restricting access to places with security system, restricting access to information and system held by computers through password, and then an internal audit department which checks that procedures and systems are operating as they should operate. So these are some of the ways through which an organization can reduce or minimize the risks that it is exposed to. But they may be able to also reduce the risks by reducing the kind of errors that are in the financial statement, reduce risks of theft of the company's assets. Then they can reduce the risks that the business might lose or provide some vital information to its competitors in that order. So that is about the risks and then about the internal audit, and we are now in relation to the internal audit. Now, so how do internal auditors, or how does the internal audit department ensure that there is good corporate governance within the organization? So what do internal auditors actually do? Internal auditors provide assurance of the company's management that systems are operating effectively and efficiently. So internal auditors must ensure that the systems of the organizations are operating efficiently and effectively. 2, that the internal control system are working well, that the laid down procedures are followed by the organization, that financial and other information are being processed in a sound and reliable manner. Now, how does the internal audit department do this? By carrying out their assignment, and 2, by producing audit reports on their findings in that order. Now, if the audit department is to be effective in providing assurance, then it needs to undertake something. 1, sufficient resources in terms of budget and people. So the internal audit department has to be given sufficient resources, the sufficient funds they need, the sufficient systems they need, the sufficient employees that they need in that order or expertise. Well organized so that it has a well-developed work practice. It has competent staff who receive high quality training, and they are independent and objective in that order. So that is what we mean by how the internal audit department ensures that the company undertakes good corporate governance. But there are limitations to the internal audit functions. 1 is about the independence of the internal audit department. 2 is about variation of standards. 3, relatively, it's a new profession, okay? It's a new area. The role of the internal audit in an organization has not really taken root as external auditors has taken root. So sometimes its limitations or its roles and responsibility is difficult to actually outline by organizations. Then the expectation gap, that is the expectation of what the internal auditors do and what we perceive them to be doing. So stakeholders may think that internal auditors are there to spy on management, or they must be there to spy on management to bring out news about, hey, management is doing this, hey, management is doing this. That is the perceived view of the internal audit function, but that is different from what the internal audit function actually does. That is what we refer to as the expectation gap. And then understanding of the internal audit. There is a negative view about the role of the internal audit department. As I mentioned earlier, people think that they are there to check up on the employees of the organization. They are there to look out for how the management of the organization are operating. So there is something like misinterpretation of their role that the internal auditors play in the organization. But if there is internal auditors in the organization, there is going to be a great function that the organization can undertake in that order. Now let's look at some assignments of the internal audit department. To consider the various roles that the internal audit department undertake, some of the types of assurance services or assignment that internal auditors usually undertake in each organization is 1, value for money or best value assignment. 2, assignment dealing with the IT system. 3, assignment dealing with project auditing. And 4, financial audit of the organization. So let's quickly look at these assignments in a bit detail. Like value for money. Value for money is concerned with obtaining the best possible combination of services for the least resources that is used. So organizations or the internal audit department must ensure that, or will work that whatever the organization is undertaking, acquisition of businesses, purchasing of assets, they achieve value for money. That is, they get the best possible combination of results from the thing in that order. Now, to look at the value for money audit, the internal audit department are interested in 3 things: economy first, efficiency, and then effectiveness. The first one is economy. This means that we getting the product at the least price. 2, efficiency means getting the best use of the resources, and then effectiveness means that the resources or the thing giving the best results. So value for money assessment or audit has to do with economy, that is obtaining the least cost; efficiency, making the best use of the resources; and then effectiveness, whether the resources or whether the thing is achieving the objective for which it was intended to achieve in that order. Then we come to what we call financial audit financial internal audit function. Now, financial auditing was the traditional main area of work for the internal audit department. So this is where they test how internal control systems are done. They look at the records to see that all invoices are there. They do audit trail to find out, they do testing procedure to find out that all procedures are being followed by the organization, and they make sure that financial statement is prepared according to the laid down principles or procedures or regulatory framework of the organization in that order. So these are some of the things we talk about. Then operational audit will include examination and review of business operation, examination and review of effectiveness of internal control system. Then they have to also look at how organization procure resources, how organization markets their products, then about treasury management, that is how the funds of the company is being managed, and then even issues about human resource management in that order. So these are what we have to understand about some of the roles that the internal audit department plays in the organization. However, the internal audit, for every work they undertake, whether it is value for money audit, whether it is operational audit, whether it is financial audit, whether it is IT audit or whatever audit, they must issue what we call an audit report. So the key principle is, who is the internal audit report for? With any report, most important, the person is the process, is the reader, not the writer. So who is the audit report for? The internal audit report for. If the audit report does not address the objective of the assignment, then it is also not good in that order. Now, so the audit report is usually given to the management of the organization and to the audit committee, okay, of the organization in that order, so that they can examine, go through it, and find out to see what the internal audit department have done, various findings that the internal audit department finds out. They document that in their audit reports, and in that report they will give also recommendations as to the various decisions, the various strategies, the various actions that the organization has to put in place or have to implement in order for the problems that have been identified to be solved, so that it helps the organization in order to achieve its objective as a company. So these are what you have to understand when we come to internal audit roles and governance in that order. Now, the role of internal auditors in corporate governance cannot be overemphasized. It is a very key role, they play a very key role in an organization in ensuring that the organization is achieving its objective, or the organization is operating efficiently and effectively. So this is where we end on the module. This is the 13th module, and this is where we end on corporate strategy, ethics, and governance. This is all you have to understand when we come to corporate strategy, ethics, and governance. I believe that it's been a fruitful journey. I believe that you understood everything that I explained. I believe that you understood the concept, the principles that we laid out. If there are any questions you have, you know what to do by now. You email me or you ping me, and I'll come in and answer any questions that you are having. My objective is that these lessons, these lecture videos and study materials will help you to pass your exam, so that you can climb to the next level on the academic ladder and as well as on your career ladder. So thank you very much, and I will see you in the advice session, where I talk about the general subjects and the various things that you have to do in order to pass the exams in that way. So thank you, and I'll see you in the final video.